Hi everyone, and so in this video I'm going to go over the Trading 180 Fundamental Analysis Spreadsheet version 4.2 and this is our guiding light. This is what we use and should really always kind of refer to if we are in any kind of doubt as to where money should be flowing into and out of in certain environments, right? So just quickly, technically, we've got four tabs that we need to always keep an eye on. The first tab is our row guide, risk on and risk off. Now, if you're not too sure what risk on and risk off is, if you go to the fundamental analysis course and then channel number 21, risk on, risk off, and I have an explainer video right here as to what risk on and risk off. But in short, the market is in generally two environments, which is risk on and risk off. Risk on is when everything is fine. There are no there is no fear, uncertainty, or doubt in the market, and traders would like to put a lot more risk on the table for higher returns. Whereas risk off refers to an environment where there is fear, uncertainty, and doubt in the market, and traders and investors will then try to put their money into safe haven assets. They're not really concerned with trying to make money as they are with protecting what they actually have. Yeah, so they're not looking for higher yielding, riskier trades. They're looking for more asset protection. Yeah, so that's in a nutshell. But this obviously video goes into a lot more depth, and also as well our risk on and risk off scale, because risk on or off isn't necessarily a light switch. It's not a binary thing whether it's on or off. There are varying degrees of risk. Anyways, back to the fundamental analysis spreadsheet. And so these are basically the rules as to typically what happens to money and investment in a risk on or risk off environment. So you can see that in certain currencies, you have commodity currencies, and when commodity currencies are currencies where countries are driven by commodity prices. The Australian dollar, the New Zealand dollar, and the Canadian dollar, their main outputs are commodities. So in a risk off environment, generally their commodity will lose value, and in a risk on environment, the value of their exchange rate would generally go higher, would appreciate. Yeah. Now you got safe haven currencies like the Swiss franc, the Japanese yen, and the US dollar, and this will again, these are typical what happens. These are not set in stone, but typically in a risk-off environment, money will flow into these safe haven assets, pushing their prices higher or appreciating the Swiss franc exchange rate, and the Japanese exchange rate, and the dollar exchange rate. And in a risk-on environment, the dollar is basically double dutches. It is in and out of risk on and risk on, risk on and risk off. But generally, the Swiss franc and the Japanese yen will generally go down. Now, again, you can look to see what typically happens in a risk on and risk off environment, or where money is flowing into and out of, right here. And then there are local and global risk events we must be aware of, which may trigger risk on and risk off environment situations, right? So we've got global risk events, we've got trade wars, coronavirus wars, Brexit, China economic slowdown would all trigger global risk events that may trigger risk off. So if you see these types of events that are front page news on various sites like Bloomberg, Reuters, Financial Times, and any of the big national publications, then you can pretty much guess as to what environment we're in, whether we're more in a risk on or risk off environment. So this is just a reminder and a template as to understand where we are and where money typically flows in a risk on or risk off environment. The next tab is our economic data tab. And this is how we determine a currency's strength and therefore its potential exchange rate, and whether a price is going to appreciate or depreciate, appreciate in value or devalue. Right now, the rule of thumb is that the higher the currency ranking, based off of GDP, interest rates, inflation, jobs, as well as government 2-year and 10-year bonds. And I'll get into that in a sec. But basically, each country is given a score in comparison and a cumulative rank. And the higher the score, right, or the higher the rank, the stronger the currency should be, right? That's just a general rule of thumb. Now, again, I urge you to go to currency value cycle number 22, because there is a caveat to that when it comes to currency appreciation and depreciation or devaluation. And again, please watch this video because it is very important to understand why there are times where we could also want to sell ones, right, which should generally want to appreciate, and sell and actually buy 8, which should generally want to devalue or depreciate. But again, just to keep this simple at the moment, the country with the highest ranking currency cumulative rank is the currency that you really want to buy, versus currencies that are ranked lower. So for example, 6, 7s and 8s, 8 is Japan, 7 is Switzerland, number 6 is Europe, for example. So you want to trade 1, 2s and 3s versus 6, 7s and 8s, basically looking for divergences, right? We're looking for the biggest divergences. So again, we use GDP year on year, quarter on quarter, interest rates, inflation rates, jobless rate, 2-year and 10-year bonds. Now, why 2-year and 10-year bonds? Bond yields, and the bond yields and bond pricing is very sensitive to what is happening in an economy in the future. So again, just to go to the bond trading education, I have a video here, right, which really explains government bonds and why it is important to keep an eye on government bonds. And so but in a nutshell, the bond traders are looking at these markers as well as some others, but generally they're looking at GDP and inflation to determine and interest rates and potential government monetary policy to determine bond prices and bond yields. So they are very, very sensitive to monetary policy and the economy and inflation. So if you understand bond yields and what potentially may happen in what the bond traders are pricing in, for example, 2 years and 10 years, you can have a really good idea. We actually have, rather than using lagging data, and doesn't mean that because I say lagging that it's a bad thing, it's just the nature of the beast. The data that we get is always going to lag, but it doesn't mean that they don't have predictive we can't predict where price or data will go in the future, but bond traders will generally tend to be very, very astute when it comes to the economy, inflation and monetary policy. And we can tell that by the way that they price their bonds, their 2-year and 10-year bonds on a bond yield curve. And again, if you don't understand, potentially you have to really kind of go over government bonds, and then you'll understand why we actually include bonds, the 2-year and the 10 years, especially with the fundamental analysis spreadsheet. So overall, this is just to get us to a place where we understand not only the data, but also where the smartest traders, on some of the smartest traders on the planet are positioning themselves and positioning government debt, right? That's pretty much what, bonds are, and where they're going to get a return, and what potentially is happening to their yield curve, which is a great sign to understand whether, the economy is going into a recession or potentially going into the growth boom phase of the economic cycle. Moving on to the pairs. So if we understand now that we want to be trading 1 versus 8, for example, that would be the biggest divergence, then what we do have is a pairs tab, and a pairs tab, what this does is it simplifies finding the biggest divergences just from a numbers perspective, right? And what we understand from the economic data tab. Yeah, so pairs, the biggest divergence should be the dollar yen, and we have the base and the quote currency right here. Yeah, we also have an interest divergence, meaning that we have interest rates. So at the moment, the dollar interest rate is 0.25, the yen is is in the minus 0.1. So there's an interest rate divergence of 0.35, meaning that if I borrow the Japanese yen, I'm going to potentially make 0.35 if I buy the US dollar. If I borrow the yen at minus 0.1 and buy the dollar at 0.25, this will be the interest divergence. Now, the bigger the interest rate divergence, the more attractive it should be for investors, right? So that's the reason why we have the interest divergence. So you can actually go here, go to sort sheet Z to A, and it gives you the biggest divergences, so you can actually see which potential currencies you should want to buy and sell. So you've got interest rate divergence, you've also got a numerical divergence as well, so you can sort sheet from Z to A, and we can see obviously from the just purely from the data as well that we have the dollar yen and the dollar Swiss have the biggest divergences when it comes to the strength, when it comes to the data, as well as interest rate divergences. So again, just looking at taking those trades, buying number one, yeah, the base currency, and selling the quote currencies. And again, just be aware that you want to do that more in a risk on environment rather than a risk off environment, simply because in a risk off environment, the Swiss franc and the Japanese yen will tend to strengthen as money flows into those currencies, as they are called safe haven currencies. So also something to be aware of, which is not necessarily on the sheet, is it doesn't mean that because, for example, you might have a currency like the, let's say, for example, the Aussie CAD, for example, yeah? Aussie CAD are ranked, the strength divergence is 1, meaning that there's only a divergence of 1 between 5 and 4, yeah? The Australian dollar being number 5 and the Canadian dollar being number 4. Now, one of the things that you have to look also towards is who is the central bank that is looking to hike, hold, or cut rates. So you can have, for example, a divergence where the Australian dollar currently are looking to hold rates, yeah, and the Canadian dollar are looking to hike rates. So that means that there's a bit of a divergence there between between the central bank that is looking to appreciate their currency first compared to one that is lagging. Now, it might not necessarily seem like a divergence, but there is a difference there. And although there is a strength divergence of 1, the Canadian dollar, in fact, would be the one to potentially buy, simply because the central bank is further along in hiking their interest rates rather than the Australian dollar, who are looking to just hold rates. So there are divergences in monetary policy that aren't necessarily, on this spreadsheet, but you must be aware of, and you will be aware of as you read up on the fundamentals and engage in the group. And so this is a great way to choose your currency pairs, to see which ones you really want to be a buyer and sellers of, and ignore the ones that haven't really got the divergences that you're looking for. Looking at the overview, last tab, and pretty much the overview, just starting off on the data releases, just lets us know from, for example, the Australian dollar, Canadian dollar, Euro area, Japan, where you have the news that's potentially coming out, or the important news that we look towards, and things that we must be aware of in the week. So the ones that are highlighted in blue, for example, the interest rate RBA chart pack, this is the blue color highlights the fact that it's coming. The announcement is coming within the next 7 days, right? So this week we've got the Australian dollar interest rate, RBA chart pack, and then we've also got, for example, on the 4th of January, we've also got inflation rate, yeah, for the for Switzerland, the Swiss National Bank, as well as inflation month on month. And we also have in the United States, we have the FOMC minutes on Wednesday. So, and it's the 1st of January 2022 today. So, the more obviously that are highlighted in this blue color is the more releases we have for that week. And then we have mean variance and forecast. Starting off with just mean variance. Mean variance is just a way to see where we are from an expensive area or cheap, and whether price is really at fair value. So let me just zoom in a little bit. So if we go to mean variance, so if you're looking at taking a trade on the Aussie dollar and you're looking for example, a short trade, looking at where price has been over the past year, is it, a good idea to look to take a short dollar trade if we are, in more of an expensive area, right? So the mean is what you would call fair value, is the average. The variance would be what is considered potentially, an expensive area or areas on a price on. Sorry, when it comes to the mean is looking at maybe where the extremes are, and then anything outside of those extremes would be considered an area where you may not want to look to trade or look to take profit, for example. So it's always a good idea to keep an eye on the mean, the variance, and where price is, if it's a bit too on the extreme end, right? So another example of that would be, let's have a quick look. Right, so let's look at dollar Swiss. I want to be a buyer of the dollar Swiss currently, yeah? But I know now when I look at where we are mean variance, that in fact we're closer to fair value, yeah, because there's something called the mean reversion to the mean type trade, where prices will always generally come back to their mean or come back to their average. And so for me, this highlights, if I'm looking at price over the past year, that in fact this might be a great opportunity to look for buy trades on the dollar Swiss. Whereas if I'm looking to buy the dollar yen, you can see that price is well away or well far from its mean, and even outside of its variance bands. It's in that very extreme mode. So would I want to be a buyer of the dollar yen at the moment? The answer is no. I'm looking for fair value. So that's one of the ways that we can look at mean variance to get a really kind of bird's eye perspective as to where fair value is, and whether we want to be buying or selling, or we're looking for basically a deeper pullback. The forecast is slightly different in a sense that we're not looking necessarily at the forecast, we're looking more at these bands, right? Again, these variance bands. And what I noticed over the past few years is that whenever prices come outside of these bands, they tend to again come back inside the mean variance. They prices revert back to their fair value, their mean. And I give an example where you've got again the Swiss dollar Swiss, where prices came outside of these bands. They don't stay outside for too long, and then they came back. They reverted back to the mean. Now these mean reversion type trades don't happen every single day or every single week, but when they do happen, they are very, very powerful. So if prices start to move towards the end of these bands, you know that you're getting to a more extreme area when it comes to either prices being very expensive or very, very cheap. So it's always worth keeping an eye on when looking to take any type of trade. Again, from a value perspective. So this is the fundamental analysis spreadsheet, something that we look at pretty much on a regular basis. I also do a weekend analysis on the fundamental analysis spreadsheet, as well as far as the data And so you're always kept up to date pretty much every Saturday, every Sunday, every weekend. We do some analysis and just to keep up to date with the fundamentals and risk sentiment. So hopefully that helps. If you do have any further questions, don't be afraid to ask. Put them in the discussion room, and I will get back to you as soon as possible. Take care and speak to you all soon.